Hi, my name is Ray.
Hi, this is Michael.
I'm going to raise economics clue book to talk about income inequality in the larger society and income distribution.
Okay.
So, what exactly is income inequality? Essentially, is basically that the fact that different proportions of the population in the country own different or make up different proportions of income, meaning that different people have different incomes in a country, and then through a Gini coefficient, we measure that amount of inequality or how unequally income is distributed throughout an economy.
Yeah.
So how do we do that? Well, let's look at this graph first. This graph basically shows income distribution in a country. So on the x-axis, we see the population fraction. The y-axis, we see the fraction of all income.
Yeah.
So, and then on this linear line right here, this would be a perfectly egalitarian country where every citizen makes the exact same income. Which the way this is showed on the graph is, for instance, what we see here, about 10% of the population, if you see, or 20% of the population see is represented here. This would mean that 20% of the population here on the x-axis will also make up 20% of all income in the country.
Exactly.
On the y-axis, so 20% of the population makes up 20% of all the income. And we see conversely also, similarly, we all see 50% of the income, 50% of the population here makes 50% of all the income, and then it goes on.
Yeah.
So, but of course, this perfectly equal country or perfectly equal income distribution is not really practical, possible, and probably not also all that desirable either. And so we see here, of course, there's going to be some discrepancy. So let's say on this line right here, and this line we have a Gini coefficient that represents income inequality of 0.33.
Yeah.
And so,
not really bad.
Not that bad. not that high. What this means basically, essentially, let's say 20%. We have once again 20% of the population right here, but this time they only make, let's say, 4% of the income right here. And then conversely, maybe like we see 50% of the population right here only makes about, let's say, 25% of the income right here.
25 to 30%. Yeah, it's about.
So essentially, obviously, there is some inequality here as the smaller proportion of the population makes a larger portion of the income, and then at the lower end, the population that makes less income, they make a significantly less income.
Yeah.
However, and then we have a Gini coefficient of even larger inequality, 0.6. Now we're reaching into some African, South American territory here. Let's say maybe like 20%. Let's redraw that a little. Let's say maybe about 20% of the population right here. We can barely even see that at this point. Only makes about 1% of the income.
Yeah. Okay.
And then 50% only makes like 5-10% of the income. That's where we reach some really high inequality levels.
Yeah.
And so how does this Gini coefficient for these two curves, how is it calculated? How does it exactly represent inequality? Well, how is it calculated? This is the formula, area A over area delta. So let's say for this curve where the Gini coefficient is 0.33, not too high. The area A is basically the area right here between the curve, the Gini coefficient curve, and the totally equal curve, or the linear line curve right here, where every population makes the exact same proportion of the income. Population proportion makes the exact same proportion of the income. So this is the area A right here, the difference between the actual country and a perfectly equal country, or a perfectly equal model.
Yeah.
And so that's the area A right here. And then the area delta basically is the area of the entire income distribution or the entire income portion in the entire country.
Yeah, that's a triangle. So
this triangle right here, basically 1 times 1 divided by 2.
Yeah.
And so that's the overall triangle here, which represents all the income in the country.
Sure.
And so that's basically how income inequality or the Gini coefficient is calculated. Basically, the higher the Gini coefficient, the higher the level of inequality.
Yeah.
You can think of it as if the area A right here, the area A represents basically the level or the difference of the difference from total equality in the country, the level of inequality in the country, and then compare the area delta as the level of inequality compared to the overall income level or total income in the entire country. So you see how much that inequality makes a total proportion of the income in that country.
Yeah, by the way, the yellow curve is called a Lawrence curve.
Yes.
It's, of course, created by the economist Lawrence, okay?
Yeah.
So
that's how it goes. And so, of course, countries might want to, for political reason, for socio-economic reason, for societal stability, they want to decrease that Gini coefficient if possible, decrease that level of radical inequality if possible, and try to get some more equality or some more support for the more disadvantaged groups in the country. And so there are different ways to really combat income inequality, and also different ways for countries, or for some governments, to maybe exacerbate income inequality. And so the main way really for the government to really lower income inequality, lower the Gini coefficient, coefficient is through taxation, in this case, progressive taxation, like U.S. income tax, or really like the law taxes, the tax systems, or major taxes in many countries, or at least many developed countries. And so progressive tax, like U.S. income tax, basically those who make a larger or higher level income basically are taxed a higher percentage or a higher proportion on their marginal income or that marginal rate.
And that basically says based on your income tax bracket, your marginal tax rate goes higher and higher. Okay, so the more you earned, the more marginal tax rate you have to pay. Okay, so that really means higher income people pay more tax and then redistribute the whole the wealth under the whole society. Okay, so progressive is basically a very effective tool to redistribute the wealth among different citizens. So
yes, to remember this is marginal tax. So only the marginal dollar above a certain threshold is taxed a higher proportion. And so there's also regressive taxes. Now, no country or no sane government actually goes out and say they're going to do regressive tax. It's obviously not going to be a very popular measure. However, there are really many ways to sneakily push through a regressive tax system. For instance, a poll tax. Poll tax is pretty notorious in the UK or famous at least in the UK under Prime Minister Margaret Thatcher in the 80s. With the poll tax, basically in the UK, it was worked as if a head household tax. Basically, households were basically taxed per head in the household or per member in the household.
Head count, basically head count. So I don't care how much you earned. How many you have 5 people in the household, you pay 5.
You pay 5 units of that.
Yeah, 5 units of that tax. It's flat.
So the way this is regressive, because statistically, basically anywhere, more low-income households usually have more children, and so as a result, more low-income families are going to pay a larger poll tax. And so this essentially, and you can argue if that was intentional or not, but essentially that it worked out effectively as a regressive tax. Also, property tax. Property tax is completely separate from your income. So even if you're lower income, if your property tax is still something you have to pay property.
It depends on even if you lose jobs, right? You still have to pay for it. It's there for eternal. So
so that property tax may make up a high proportion of a lower income person's income than a higher income.
Absolutely.
There's also proportional tax like sales tax or gross receipts tax. Sales tax obviously it's a flat rate on all goods, at least theoretically. And so, but of course, some argue sales tax is also effectively a regressive tax because, of course, lower income people have a higher propensity to spend, so they pay more of that sales tax or more amounts of sales tax
out of their income.
Than
but a lot of states for the necessities, like grocery shopping, they don't have any sales tax. So that's one way to just help the low income people to just reduce their tax burden.
Yes, but in the European countries, for instance, with that value-added tax or VAT, which essentially works similarly to sales tax effectively, they also may exclude necessities from that VAT and maybe tax luxuries higher. And so there's also lump sum tax, which is basically effectively still a regressive tax.
Of course.
Like car tax fees or a lump sum, basically because a lump sum tax, that lump sum makes up a higher proportion of poorer individuals' income than higher income individuals.
It's just lump sum means just by the name, right? Like automobiles tax fees. Whether this automobile is a luxury car or just an ordinary car, it's the same rate.
We see. So maybe the U.S. fines, for instance, are also kind of a lump sum regressive system as well, car fines or parking fines or whatever. So final clues: the Gini coefficient is also derived from Lorenz curve. The Lorenz curve, basically, we see here represents our total level of inequality, and then we see that difference from the total equality compared to our total income table in our entire country represents our Gini coefficient that represents the total income inequality. So the higher Gini coefficient, the more inequality. Sweden has a Gini coefficient pretty low at 0.249. The U.S. is pretty high for a developed country at 0.45. Actually, the highest for any highly developed country. And South Africa is probably one of the highest, if not the highest in the world, at 0.625.
That's the data from 2019 from CIA. So CIA, and then so it's right now it's 2020, so it's still pretty relevant. And in fact, the one of the lowest is all from from like European countries. For example, Slovenia and Slovakia actually even lower than Sweden. Okay, so
the government can actually levy taxes to redistribute wealth. The key is to have a higher marginal tax rate when income or asset value or assets owned get higher.
That's very important because when we say it's progressive tax to redistribute wealth, we really means the marginal tax rate goes higher and higher. So that's why higher income, higher tax payment. So see you next time. Bye bye.